Procter & Gamble, ticker symbol PG, is currently trading at $146.72 a share. This is a favorite stock among dividend investors due to its 2.49% dividend yield and its status as a dividend aristocrat. What we're going to be doing today is looking at the company's financials and seeing if it is a buy or a sell based on my valuation models using discounted free cash flow model, the Ben Graham model, and finally the comparables companies model. So as I said before, this stock is a favorite investors because of its status as a dividend aristocrat. Well, what is this? Well, the stock has to be in the S&P 500. It has to increase its dividend for 25 years, and it has to hit certain minimums in terms of market cap and free cash flow. If we look at the list, Procter & Gamble has had consecutive dividend growth for 66 years. It's actually one of the highest and longest stocks on the Dividend Aristocrats list, so you know it's a safe dividend. If we look at the stock price over the last year, yes, it is down almost 5% over the last year, but if we look at the stock over the last 5 years, it is up almost 87% from $80 to $146. If we compare that to the S&P 500 over that same time, you would expect the S&P 500 to beat this, but no, despite this paying a massive dividend, it is also beating the market over that time, 87 compared to 52%. So let's have a look at my stock valuation spreadsheet. First, we will enter the ticker, PG. If you want to see the spreadsheet, please check out my Patreon, links are in the description. But let's have a look at the stock. So as I said before, it has a price of $146, market cap of $346 billion, PE of 25.77, which is slightly higher than the market average, which is around about 21, 22. Earnings per share of $5.69, and a beta of 0.4, which should mean it's a lot less volatile than the current market. If we have a look at that dividend yield, yes, 2.5%. Let me just make this full screen here. 2.5% dividend, a massive $3.65 per share dividend. And if you want this dividend, buy before the 19th of April, 2023. Now, is the dividend safe? They've been increasing it for 66 years. You can see here, these are the payout ratios. They currently pay $8.6 billion. In terms of net income ratios, it's about a 60%, which is on the high side but safe, and free cash flow ratio of 74. Now let's have a look at the financials, but before then, can you please give a like on the video? Let's try and get this one to 15 likes. I think that'd be quite nice. And subscribe if you're not already. So we will have a look at the revenue. Is revenue increasing? Yes, it is. 66 billion to 80.2 billion. And even in the trailing 12 months, it's increased a little bit to 80.3. Even in the pandemic years, it did not have a drop off, has had consistent revenue growth. Now let's have a look at the net income. Is that increasing? Yes, just shy of 10 billion, down in 2019, but has rebounded very, very strongly, currently at about 14.3 billion. So that is once again increasing. Are they buying back their shares or issuing more shares? Well, they're actually rewarding shareholders by buying back their shares. They've done a steady buyback program from around about 2.5 billion to 2.4, buying back about 1% of their shares each year. That's very good to see, rewarding investors. Now, finally, are they growing free cash flow? Yes, you can see here 11.2 to 13.6 in 2022. Trailing 12 months is down a little bit, 11.6. So we'll have a look at that later, but they do have their earnings coming up soon. So it'll be interesting to see if their free cash flow is growing. But we'll have a look at the valuation methods firstly. We'll be looking at free cash flow model. We calculate the future free cash flows, discount them to today's value, and then this will give us a fair value of the stock. So currently, discounted free cash flow absolutely loves this stock, $366 a share. Now let's see if these numbers are correct. Firstly, we want to see the revenue growth rate. What is the company growing at? You can see in 2019 it had a dip, but it's currently been around about 6 to 5%. I think this is a fair number here, 3.55. Net income margins as well, 15% is the average. You can see here that that number is not far out. The only one which I think is a bit out here is the net income to free cash flow rate here, because of the big number in 2019. So what we'll do is we'll take an average of these four numbers here, which is around about 106%. I think this will drop the price down a bit, but it'll still love the stock. Yes, $265 a share, and I think these numbers are a lot more fair. So discounted free cash flow really likes the stock. Now we'll have a look at the Ben Graham formula for value investing. This is the father of investing himself, Ben Graham, and what this does is it looks at earnings per share versus the growth of a the P of a non-growth company times by the corporate bond and the corporate bond average. If we have a look at the corporate bond value right now, still in February, 20, I don't know why I said 20, 4.56%. So we already have that. And then the expected growth rate of PG, if we have a look at Yahoo Finance, what are they expecting over the next 5 years? If we scroll down here, we can see that the percent is around about 5.07. Also, the past 5 years is 7.6. So we'll have a look at both those numbers now. So if we go back to here and do 5.1%, that would give a share price at around about $67 a share, and a Graham price, which is sort of a buy and hold price with a margin of safety of 50. If we look back to the price, when was PG last a $60 stock? Well, you've got to go pre 5 years ago. So that number is a little bit on the lower side, but a very conservative number. If we have a look based on the next 5 years and compare them to the previous 5 years, that was 7.6%. 7.6%, we'll put that in. If they were able to grow at that same rate, it's an $80 stock. And finally, let's have a look at the comparable company model. What this does is it looks at, well, basically comparable companies, looks at their metrics and tries to get an average here. The ones that we're looking at are EV to revenue, EV to EBITDA, and PE ratio. So in terms of companies that are very similar, first ticker I'll look at is J&J, obviously Johnson & Johnson. Next, CL, which is a Colgate-Palmolive company. And then finally, KMB, which is Kimberly-Clark. So this will give us the metrics here, the ratios, EV to revenue. What we want to see is lower is better. And initially we can see that PG has the highest, comparable to Johnson & Johnson and Colgate-Palmolive. Kimberly-Clark is a lot lower, 2.7. Next, EV to EBITDA, lower is better. And you can see that PG is about in the middle, 18 compared to 15, 20, and 17. And PE ratio, one of the lower numbers actually, 25, 33, 23, and 22. So we have the averages here, and based on these EV to revenue, that would give a value around about $127 a share. EV to EBITDA is 129, and PE ratio, you can see that it is undervalued based on PE, $162 a share. Now, if we take an average of these, this will give us around about $140 a share. So discounted free cash flow levels of stock, Ben Graham says not so much, and comparable company says it's pretty much fairly valued at where it is right now, but obviously you're getting that 2.5% dividend paid to you obviously over the year. So this stock does look pretty good and a staple for dividend investors. Right guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already. Obviously check out my Patreon, links are in the description for my stock valuation spreadsheets. And I'll catch you guys next time.